Greetings, and thank you for joining us today. I'm Steve Kamin, a senior fellow here at the American Enterprise Institute, and it's my pleasure to welcome you to this morning's event on the prospects for the U.S. economy in an era of big tariffs, big budget deficits, and who knows what else. I especially wish to welcome our panel of highly distinguished experts. They will have the thankless task of providing accurate, detailed, and completely reliable forecasts of economic developments in the face of huge uncertainties looming on the horizon. For starters, nobody knows where tariffs are going to end up. According to the Yale Budget Lab, average tariffs are now nearly 18% compared to just 2.5% before President Trump took office. But there's a lot of trade deals still to be done. And given Trump's penchant for capricious policymaking, where they're going to end up is anybody's guess. Second, tariffs are a supply shock that will both lower growth and boost inflation. But by how much? Nobody knows. So far, a lot of indicators, such as inflation and employment, stubbornly refuse to show any response to the tariffs. And this conundrum is undoubtedly perplexing the Fed's FOMC, which is meeting even as we speak. It's a sure bet they're not going to move interest rates today, but what will they say this afternoon when they have to release their own projections for the economy? Third, Trump's big beautiful bill remains a big beautiful question mark. The CBO estimates that the version passed by the House is going to add 3 trillion bucks, including interest over the next 10 years to the deficit. But what's the Senate going to do? And what will be the effect of rising deficits and debt on the demand for treasuries, interest rates, and inflation? And then fourth, what will all this do to the international role of the dollar, which has now fallen some 10% since Trump took office? And finally, how about the hostilities between Israel and Iran? What will they do to global oil markets and the global economy? So such uncertainties might prove daunting to lesser economists, but I have great confidence that our panelists are going to surmount these challenges, sort out the issues, and highlight the key factors that are going to influence the outlook. So in the order in which they'll speak, Jason Furman is the Aetna Professor of the Practice of Economic Policy at Harvard University, as well as non-resident Senior Fellow at the Peterson Institute for International Economics. Among other activities, Jason's been a top economic advisor to President Obama, including chairman of the Council of Economic Advisors, an advisor on economic policy during the Clinton administration, and he's also headed the Hamilton Project at Brookings. Mark Sobel is the U.S. chairman of the Official Monetary and Financial Institutions Forum, often called OMFIF, which is a think tank for central banking, economic policy, and public investment. Before joining OMFIF, Mark served as the U.S. Department of the Treasury at the U.S. Department of the Treasury for nearly 4 decades, including as Deputy Assistant Secretary for International Monetary and Financial Policy from 2000 to early 2015. In the 3 years since then, he was the U.S. rep at the IMF. Mark and I have worked together for many years, and I hope that our relationship will outlast this event. Jan Hatzius is chief economist and head of global investment research at Goldman Sachs. He was named managing director in 2004 and partner in 2008. Before joining Goldman Sachs, Jan was a research officer at the London School of Economics. He's the #1 ranked global economist in the annual Institutional Investor Global Fixed Income Research Team. And he's a member of the economic advisory panels of the Chicago Fed and the Congressional Budget Office. Last but by no means least, Desmond Lachman is a senior fellow and a colleague of mine at AEI, where he writes extensively on monetary policy, emerging market issues, and the financial system. Before that, he was managing director and chief emerging market economic strategist at Solomon Smith Barney. Desmond previously served as deputy director in the International Monetary Fund's Policy Department and Policy Development and Review Department. If you in the audience have questions you'd like to ask of the panelists, you can send them to Atman Vakil via email or Twitter as indicated at the bottom of your screen. So without further ado, let me give the floor over to Jason to start our discussion.
So it's great to be with all of you again. And Unless you're a professional in financial markets, you may have forgotten that today is the FOMC meeting. This will, with near certainty, be the fourth meeting in a row where they don't move rates. You can try to get yourself excited about their dots in the summary of economic projections, which we haven't seen since 3 months ago. But I wouldn't get yourself very excited about it because they don't know what they're going to be doing going forward because of the enormous magnitude of uncertainty. For the first time in about 3 years, there is actually, and arguably longer than that, it's the fiscal side that is more interesting and consequential, both for inflation, unemployment, and also for interest rates, at least long-term interest rates, than monetary policy. And fiscal policy, we are right in the middle of two streams of it. One is the set of tariffs being done under executive authorities, authorities that in many cases are contested in the courts right now by the president. And the second is the one beautiful bill that is passed the House and is now being moving forward in the Senate. This legislation, the Congressional Budget Office just scored it yesterday, and quite remarkably found that on a dynamic basis, it would add even more to the debt than their estimate on a static basis. That is because in the Congressional Budget Office's reckoning, the you get slightly higher GDP, largely reflecting the demand side of the bill. You're not getting a lot of extra economic growth from things like no tax on tips, expanded standard deduction for senior citizens, and auto loan interest deductibility. So you're getting some Keynesian extra demand and higher GDP, but you're also getting interest rates that the Congressional Budget Office estimates will be 14 basis points higher over the next decade. And those higher interest rates mean you end up with a $3.3 trillion increase in the debt. That adds 7 percentage points to the debt to GDP ratio, a debt to GDP ratio that was already expected to rise by about 20 percentage points over the next decade. So, this legislation, depending on how you look at it, it raises the debt to GDP and raises it even more than it would have absent any action by Congress. Now, one big uncertainty we face across the fiscal impact of this legislation, the shorter run macro impact of the tariffs, is to what degree does one use your sort of standard linear economic models versus to what degree do you think there's something that's outside your conventional model that might lead effects to be magnified? In the fiscal context, if you look at something like the mini budget that Liz Truss put forward a couple of years ago, that was about 1.5% of GDP. That's the same magnitude of one big beautiful bill, but it caused the largest movement in gilts in modern history. Part of that for technical reasons relating to holdings of insurance companies in the UK, but part of that because it was not just the linear effect of the extra debt, but the nonlinear effect of a perception of potentially removing independence from the Bank of England, ignoring the Office of Budget Responsibility, firing the top civil servant in the Treasury, and the like. We haven't seen anything like that in the United States with one beautiful bill, even though it's the same size as Liz Truss. It is, long-term interest rates are about where they were 12 months ago, and you don't see any sort of form of nonlinear response. So the 14 basis points the CBO assumes is sort of the reasonable, rule of thumb of maybe 2 basis points for each percentage point on the debt. So you had 7% of GDP to the debt, you had 14 basis points to interest rates. My view is the risks on that are very asymmetric. CBO only has the 10-year at 3.8% in their forecast. Absent this, it would go up to about 3.9 with this. That is considerably below what financial markets are forecasting, considerably below where interest rates are now. And so, if anything, there's a risk to the fiscal forecast that the debt will be higher as interest rates are higher. The same nonlinearity plays out in tariffs. An 18% average tariff rate is way above what I was expecting for this year or what investors and forecasters were more broadly. I expected the average tariff rate to go something like from 3% prior to Trump to something more like 8%. So instead, we're at 18%. Notwithstanding that, if you look at the real GDP consequences, you don't, out of a linear model, get more than, say, 0.5% out of that negative on GDP. And you don't get more than a percentage point added to the inflation rate. These types of linear models went badly wrong in 2021. They dramatically underpredicted inflation because something sort of outside the standard Phillips curve relationship happened. That being said, most of the time, I do think the economy is surprisingly smaller in terms of the consequences of policy than you think, that there's lots of drama, lots of excitement, but when it comes to the macro impact, it's measured in tens of basis points, not necessarily in percentage points. Now, I would note that if GDP was lowered by 0.5% because of tariffs, that would still end up being $1,000, for each and every household in the country. That would be a phenomenally stupid thing to do in terms of public policy. It just wouldn't be sort of historically noticeable or even sort of an undeniable fact. People would debate what it exactly it was, ended up slowing GDP growth. Perhaps the larger thing than either of these in terms of GDP is immigration and switching from net inflows of 3 million a year to a net inflow of at most 500,000 a year takes maybe a percentage point off the potential growth rate. It's something we're seeing in labor markets where job growth has slowed relatively rapidly, but the unemployment rate is still rising only very, very slowly. And that's because break-even job growth is a lot lower than what we think. If you want to be in the nonlinear, school of thought, you could point to the unusual correlations between interest rates and the dollar, where the United States looks more like an emerging market than it does like an advanced economy. You could look at surveys that show very high rates of uncertainty and businesses that claim that they will be cutting back their investment substantially as a result. And you could say we just need to wait a quarter or two for that more dramatic event to happen. Nevertheless, at this point, my money is number one on uncertainty about the consequences of uncertainty, uncertainty about the outlook for uncertainty, but an underlying belief in the robustness of the US economy and that we're going to get a bit of extra inflation because of these policies, a bit of slower growth because of these policies, but it will be almost hard to extract that signal from the noise because it won't put us into completely new territory. What that means for the Fed, I don't think there's anything that could reassure them enough to cut rates in July. In September, I continue to think that it would take actual material slowdown in the economy, a meaningful rise in the unemployment rate to put interest rate moves into effect, that they'd wait at least until December for a rate cut that was based on reassuring inflation rather than concern about the real economy. And that part of why they're not going to say anything this afternoon is that they themselves are uncertain, When a business is uncertain, it delays an investment decision. When a central bank is uncertain, they try not to be ahead of the curve because they don't want to be ahead of the wrong curve. They end up being inevitably behind the curve, but not sure which one. That it turns out they'll be behind. Is it a slowing economy, rising inflation, or maybe even the robust continuation of the Goldilocks we've had for some time now? I look forward to hearing what everyone else has to say.
Me too. Jason, thank you very much for that great overview presentation. It raises so many questions, I'm not even sure where to start. But first, I just want to kind of confirm with you. So sounds like you're calling for a modest but not too big decline in GDP growth, kind of like relative to earlier expectations, some increase in inflation, and one cut, one Fed funds rate cut. Is that about right?
Would be the bottom line with a even wider than usual confidence interval around all of that.
Sure, Natch. But I'm trying to pin you down so that way we can compare with what our other participants might be thinking on this. As many people hopefully are both watching our presentation and then tuning in for the Powell's press conference later today so they can compare and contrast.
This
But
is going to be so much more interesting than his press conference.
oh, well, that should be the case since those press conferences are mainly about the reporters trying to get him to say something and him saying, "I'm not going to say anything." But let me ask, well, first of all, a picky little question, just because it actually is something I'm interested in. You mentioned that in the dynamic version of the CBO analysis of the Big Beautiful Bill, that they had a higher interest bill because of interest rates going up. In the original kind of like 2.5 trillion number that CBO came up with, did that not include interest payments at all? Or included higher interest payments due to higher debt, but not higher interest rates?
That original number was the primary deficit. It did not include interest rates. In their new estimate, it's a bit over 400 billion, and that is just the higher interest rate on the baseline debt. That's
Wow.
not even the extra interest you get because you have a higher primary deficit. So you're getting an extra 400 billion on the higher interest rate. Then you're getting even more on top of that because of interest on the new primary deficits.
Okay, so why would they not include the higher interest payments just due to the higher debt in the static assessment, since that seems like a very natural, logical kind of thing to put in?
They pretty much never have, but I wish they did. And you'll pick up the newspaper and it'll say CBO says this bill will raise the debt by 2.4 trillion. And I made a valiant effort to get one newspaper to say it would raise the primary deficit by 2.4 trillion, and they just sort of laughed at me. So when they come out with these estimates, you have to either compute it yourself or look to other places like the Committee for Responsible Federal Budget usually does a very rapid version of just adding the static interest you get because of running a larger primary deficit.
All right. Okay. Well, actually, Desmond wants to say
Yeah,
something.
I've just got one question for Jason. You mentioned possibility of non-linearities. You also mentioned Liz Truss. My question to you is, why do you think those things aren't going to occur if we're on such an unsustainable path? I mean, it's a question in terms of timing. You can perhaps say it's not going to occur tomorrow morning, but if you're on a ridiculously unsustainable path, surely the non-linearities are going to kick in.
So, first of all, I think the market is closed tomorrow. So I'm going to go out on a limb and say that it won't happen tomorrow on
It could
Juneteenth.
happen in Japan.
But yes. Oh, look, I mean, if you do your forecasts and you don't attach a date to them, you're usually going to be right with anything you forecast because eventually everything will happen. And there is definitely a risk, and the risk grows every year. Moreover, and I didn't really talk about this, the Big Beautiful Bill itself, it has a set of cliffs that disguise its true cost. So you want to think of it as raising more like, 5 or 6 trillion on the debt if everything got extended as they clearly intended to. So absolutely, there's a risk of those nonlinear effects. Absolutely, the longer you go, the more likely they happen. But I guess if you looked at a 2 or 3 year time scale, I'd sort of take the 90% bet against them. But 10% is more of a chance than we should be willing to take.
All right. Well, many more questions are prompted by this, but let's hear from our other experts first, and then we can chat all the way till 2:30 this afternoon when we have a hard stop because that's Chair Powell's press conference. Mark, what can you tell us about current events?
Well, thank you. It's an honor to join Jason, Jan, and Desmond, and my good friend Steve Kamin. Taking into account some of the questions that Desmond had posed to us, I decided I was going to address three questions today. First, how effective will the administration be in tackling the trade deficit? So J.D. Vance and Stephen Myron have argued that because of the dollar's globally dominant role, it's overvalued. That causes trade deficits and hollows out U.S. manufacturing, and that rips off Americans. So the answer is a lower dollar, tariffs, and penalizing foreigners who want to access U.S. capital markets. Now, our capital markets attractiveness, in my view, does bring large flows into the U.S. and bids up the dollar. Excess savings in some countries and at times harmful currency practices influence our trade deficits, but that focus can be exaggerated. Assessing the dollar's value is more complex and pointing to the dollar's global role or blaming foreigners. It's influenced importantly by our fiscal monetary mix. And while the dollar has come off recently, the real dollar exchange rate remains very strong still. That strength has been underpinned in recent years by Fed rate hikes. And even after the Fed cut a bit, favorable interest differentials often remained as some others cut more quickly. And meanwhile, our large budget deficits and relatively higher inflation prop up the yield curve. So the U.S. current account deficit equals the gap between our savings and investment. If the U.S. wishes to reduce that gap in our current account deficit, it should increase national saving. Now, the best way to do that would be to reduce our fiscal deficits. But our massive unsustainable deficits are now 6+% of GDP. And especially if the big, beautiful bill is passed, deficits are projected to remain that high, if not higher, as far as the eye can see. From the standpoint of reducing our trade deficits, we're headed in the wrong direction in many respects. And the problem isn't that we have a trade deficit. In return for our deficit, we get nice products that we need for daily life. Imports keep a lid on U.S. inflation, and autarky is no answer, as Thomas Jefferson learned in 1807. The main problem is that our trade deficit is deemed excessive due to undesirable U.S. policies, and that is under our control. Manufacturing share in GDP has fallen in advanced economies for decades due to productivity gains and technological advances, far more so than globalization. Manufacturing is less than 10% of our GDP. Even if the U.S. bolstered reshoring and manufacturing, the share gains wouldn't likely be material, and businesses will substitute capital for labor, can we say robots, such that employment gains will be minimal. Okay, second, how will tariffs and the big, beautiful bill impact the dollar? Recently, headlines observed that since early March and then Liberation Day, U.S. longer-term rates have risen, and yet counterintuitively, the dollar has fallen, raising questions about the dollar's safe haven status and whether this is a harbinger of the demise of dollar dominance. And we see events in the Mideast these days, and the dollar is not rising as the safe haven currency. So dollar dominance is neither an exorbitant privilege, as many Europeans believe, nor an exorbitant burden, as Vance and Myron argue. It's a net plus. The reason it's dominant is because we have a huge economy, the deepest, most open liquid capital markets in the world. We've had good rule of law, strong institutions, and network effects. Past macro policy was arguably decent, and importantly, we've been a trusted partner and ally. On the plus side, Americans face less exchange risks. Our interest rates may be a tad lower. We gain some seniorage, and there is geopolitical leverage via financial sanctions. These are properties we should protect. On the minus side, deficits have long aggravated or been associated with protectionist pressures in the US, as we're now seeing. But again, dollar dominance is a net plus. Now, it would be one thing if the dollar's recent decline were a product of improved fiscal policy and lower rates. The dollar floats after all. But insofar as it reflects tariff actions, global uncertainty over future US trade policy, higher inflation prospects, fears of bond market saturation, attacks on institutions, including the Fed, and not being a reliable ally, we are harming properties that support American prosperity. That seems ill-advised and will, over time, erode trust in the US and the dollar. And foremost, and most importantly, in my mind, we will hurt ourselves as Americans. Now, CEA Chair Myron has recently walked back from his Mar-a-Lago piece, but his coercive capital market ideas, such as compelling others to term out debt or pay user fees, seemed antithetical to the openness of our capital markets, let alone our need for foreign financing for our fiscal deficits. In this regard, Section 899 of the Big Beautiful Bill would potentially tax foreign portfolio investment from residents in countries that levy what are considered unfair taxes on U.S. companies. And the Big Beautiful Bill includes a remittance tax. So the ill-advised spirit of coercive capital measures seems to live on. That said, a word of caution. Jason said we sometimes get too worried about uncertainties and whatnot. The demise of dollar dominance has long been predicted. A cottage industry started some 60 years ago, and yet it hasn't happened. The 10-year Treasury is up modestly since Liberation Day. The real trade-weighted dollar is still quite strong. There aren't good alternatives to the dollar for the foreseeable future. Perhaps one can add some euros, Canadian, and Australian dollars and golds to one's portfolio, but who's rushing into RMB? Despite what I read in the FT this morning about the speech of the Chinese central bank governor. Plus, asset managers only rebench portfolios very gradually. I will add that our moderator, Mr. Kamin, and I have written together on the dollar, including a piece on the Mar-a-Lago Accord, which Steve originated and drafted. So if I've said anything questionable, it's my fault. And if I've said anything that sounds intelligent, all praise goes to Steve. Third, what might be the meaning for U.S. debt and deficits and the Fed? By some estimates, the U.S. debt to GDP ratio will rise towards 130% over the next decade. And the Big Beautiful Bill could add up to $5 trillion. As Jason mentioned, if you assume the measures are made permanent for the 10-year window. We don't know how much tariff revenue will be generated due to all the uncertainties over where we will end up. Now, when you look at ratios around the world, one assumes the U.S. can finance a debt to GDP ratio of that magnitude. But annual deficits of 6% of GDP or higher mean a lot of treasury paper flooding the market. And that may prove difficult to digest, especially given changes in market structure. And that means increased volatility and a higher and steepening yield curve, crimping investment and economic activity. Meanwhile, tariffs will add to inflation, certainly in the short run. So the U.S. may be looking at slowdown and or stagflation. And as virtually all forecasters have shown, the direct impact of tariffs plus the uncertainties are also going to depress global growth. And we've already seen that in IMF, World Bank, and OECD projections. Now, to pick up on something Desmond mentioned in his questions, I worry about such a scenario for the Fed. Now, I'm not a Fed person, I'm a Treasury person, so I'm going outside of my league here with the experts, so maybe I'll get into trouble. But it seems the president is already trying to shift blame onto the Fed. I have little confidence our politicians are ready to adopt fiscal responsibility, and they too would rather blame somebody else. So notwithstanding the Supreme Court's recent defense of Fed independence, I fear down the road creeping fiscal dominance. The executive branch and the Congress may ultimately pressure the Fed or try to pressure the Fed to undertake yield curve control or renewed quantitative easing and address America's budgetary irresponsibility through financial repression. That is, unless there is a bond vigilante-inspired Congress, crisis, which might be what it takes to force some fiscal responsibility on the US. And if that wasn't cheerful enough for you, Steve, I will wrap up with a futuristic scenario that worries me. The world loses trust in its recognized safe asset and can no longer avert its eyes that something is amiss. There is no obvious replacement. Wither the global financial system. And on that happy note, back to you, Steve.
Thank you, Mark. That was quite a bit to digest. Let me start by saying that nobody does humility like you do, and it is exaggerated since you are a incredibly trusted, thoughtful, and insightful partner in our previous screeds on dollar dominance. Now, on the subject of dollar dominance, you sound a little conflicted. On the one hand, you suggest that the administration's policies, are certainly destined to sound the death knell of the dollar's global dominance. On the other hand, you kind of suggest that there are no alternatives, really, to a dominant currency in the global financial system. I'm wondering whether is it possible that the dollar could kind of like lose its safe asset status? In other words, rising during good periods and falling during bad, and perhaps as a result, maybe lowering the share of dollars in international reserves while still maintaining its predominance in kind of like private lending and borrowing, invoicing, pricing, that kind of thing. Is that kind of bifurcated situation a possibility?
Now, that is an interesting question. Again, I'm not projecting the death knell of dollar dominance. I guess, as you put it, I see erosion, and I think we're eroding the properties that underpin that. So, as you and I have noted, that the dollar is very strong on a reserve basis, but if you look at all these private sector indicators, it's even stronger. So that's kind of harder to unwind. But that too can erode and whatnot. So you know, I and as you and I have discussed, sometimes we focus way too much on is it dominant as opposed to why is it dominant, right? And it's dominant because of these good things these good properties we have. And so the real issue to me is much less about is it dominant or is the reserve share 57 or 49? To me, the issue is the US running sound policies and are we doing what's right for Americans? And to me, that's the real issue. So yeah, maybe I'm a little bit conflicted, but I see the trends continuing, but I also see a lot more volatility caused by our errant policies.
Yeah, that makes sense. Let me ask about an area that you've had a lot of familiarity with, which is kind of like treasury, kind of like processes to address kind of like the dollar and kind of like unfair dollar competition. So you recently uh, issued an interesting report on the Treasury's FX report, looking at how other countries might basically use unfair means to bolster their competitiveness. Given that the dollar's fallen 10% and given that the administration is pursuing many policies that seem to be weakening the dollar. Does it make sense for the Treasury to continue to pursue these issues like in the FX report? Can you talk a little bit about that?
Well, the Treasury has to write the FX report because it's mandated by congressional law that we do it
Right.
twice a year. Um, as I said, I think that foreign practices um, and be it excess savings or harmful currency practices, which we have seen, are certainly something that should be on the Treasury docket. So I think it's fair to pay attention to these uh, issues. Now, in the latest Treasury report, they didn't find manipulation of anybody, and despite some very hawkish Trumpian rhetoric. But of course, how could they? Because other currencies were under downward pressure and they were supporting their currencies. Um, what I find a bit of fault with the Treasury report, and it's inherent to being an American product, is that so the administration and Scott Bessem's IMF speech, or more generally in the G7, we saw this in the last G7 finance ministers communique, talked a lot about global imbalances, something all of us are very familiar with. But and you can apportion blame in your relative analysis and whatnot. But basically, if there's a surplus, there's a deficit, right? It takes two to tango. And so I think, as I mentioned in my comments, the U.S. is running these massive fiscal deficits, which reflects the saving investment imbalance and gets reflected in the current account deficit. And the dollar has been strong because of U.S. policies. So there's a very strong U.S. element to global imbalances, which the Treasury report is loath to go into because you always say rah rah rah. The administration's perfect. Um, this is true of Obama. It's true of Trump, right, or others. So I think that the last report vastly understated the U.S. Responsibilities in global imbalances, and it didn't connect the dot. And I thought there was a lot of good work on the China section. I totally agree with the Treasury. They should be pursuing greater transparency in foreign exchange practices with other, I think China's interesting because they have this massive current account surplus, and yet they have these capital account outflow pressures, which is keeping it down. The Treasury report also surprised me because they pretty much said, Japan, you should raise your interest rates faster to support the yen. Well, Japan's got all these domestic issues and own reasons, but so I thought that was parochial, and I don't recall in all the years I ever overwrote it that we wrote something similar for a G3 economy and whatnot. Other than that, there were the usual good things. I guess my last comment would be when I used to oversee the Treasury report, I always had this wish, this foolish aspiration that it would be seen as a Humphrey Hawkins report on the global economy from the Treasury. But basically, everybody in Congress just read the first line: is China a manipulator? And when the answer was no, they threw the paper into the trash can. And that always I found regrettable, because I think if you are willing to forego your sleeping pills for the evening and read the Treasury report, there's phenomenal wealth of excellent analysis in it by the Treasury staff.
All right, folks, you heard it here first. I guess Desmond has a question, but he can't ask it until he unmutes. And then we do need to move on after that.
The question might have been better when I was muted. The question I have for Mark is, should we be worried about the dollar's impact on inflation? That I don't see much discussion of this issue. It seems to me that if you've got a 10% depreciation of the dollar and the dollar's going to fall further, that is amplifying the effect of the tariff. Am I mistaken in thinking that a 10% devaluation of the dollar is equivalent to an across the board 10% tariff, from the point of view of inflation? So, kind of like the thing that I'm concerned about is you've got the dollar falling, you've got tariffs increasing, and now you've got oil prices rising. That doesn't make for a very happy inflation outlook.
Well, I agree with you. The inflation outlook isn't the happiest. Our wonderful moderator may have a better handle on all the rules of thumb and whatnot, but if you have a 10% dollar depreciation and
1/3 pass through, so that gives you 3% multiplied times the share of goods imports in US GDP, which is 10%. That gives you about 0.3% on inflation.
good, I was going to say 0.2. So Steve and I are pretty close.
All right.
But I go with the Fed. They're smarter than Treasury guys.
That humility again. I'm hot to hear what Jan and Desmond have to say, but one quick one, Mark. How many cuts? 0, 1, or 2?
1.
All right, one cut. All right, Jan, you're on, and we look forward to hearing some, what you have to say about the mechanics of the U.S. economy.
Okay, thanks so much. Can you see my screen?
Yes.
So I'm going to talk a little bit about our outlook on the economy and how that has shifted. And after a pretty lengthy period where we had generally, a similar view and, consistently optimistic relative to most forecasters, similar types of debates, mostly pushing back against a variety of more negative narratives. This year has seen a lot more changes, basically because the increase in tariffs was so much bigger than what we expected, similar to what I think Jason noted. And on the right-hand side, you can see what that did to our estimate of recession risk over the next 12 months. Came into the year at 15%, the unconditional long-term average. We moved that up to 45% in early April. In fact, for about a 2-hour period or less than 2-hour period on April 9th, we were above 50%. We moved to a recession baseline when all of the quote-unquote reciprocal tariffs took effect. 20 minutes later, President Trump paused much of the reciprocal tariff, and we went back to the previous 45%. And we've generally been moving it down from there on the back of basically a reduction in our estimate of where tariffs ultimately will end up, and also stabilization in the estimated level. We've now been basically at around 14 percentage point increase in the average tariff rate for effectively 2 months. It's varied between sort of 13 and 15 or 13 and 16. And there've been lots of changes in terms of the details, but the overall we're at still a very similar level as 2 months ago. And I think the fact that from a macro perspective, these things haven't changed that much, that's resulted in greater certainty on the parts of investors, rebound in asset prices, and also a decline in some of the common measures of uncertainty, policy uncertainty, trade policy uncertainty from Baker, Bloom, and Davis or Iacovello. I should just note, Jason talked about an 18 percentage point increase in the average tariff rate. I have a 14 percentage point increase in the average tariff rate. And this is really, the difference is really driven by whether you try to build in the responses of imports to tariff rates, or whether you basically take 2024 import shares and multiply that with the increases in tariff rates. We're trying to estimate something that is consistent with the long-term history that I show on the right-hand side here, which is customs revenue as a share of goods imports. And for that, you need to build in an estimate of how imports are going to shift. Now, where are we right now? We've seen so far an increase in tariff rates of about 10 percentage points by our estimates, and we're expecting approximately another 4 to 5 percentage points to come from the 25% sectoral tariffs on things like semiconductors, communications equipment, pharma, copper, and probably a few other things. That's the big additional tariff increase that we're still building in. We're not building in additional changes in China tariffs. We're keeping those at 30 percentage points cumulative increase in 2025. So we're not looking for renewed escalation, but also are skeptical that China is going to manage to persuade the White House to take off the fentanyl tariffs. And we're also not building in the second stage of the reciprocal tariffs that are currently paused, that are expiring on July 9th. We expect that to continue to be pushed out. And obviously, there's significant risk around all of these individual assumptions. But more broadly, I'd be surprised if we were very far away from this kind of 13, 14, 15 percentage point increase. Now, what is the impact on growth? We're estimating currently a hit of about 1 percentage point, or peaking at 1 percentage point from the tariff increase in the first quarter of 2026 on a year-on-year basis. That is a little bit bigger than the estimates, at least the long-term estimates, ex uncertainty that Jason talked about, but not massively bigger, not enough to turn an economy that's growing, maybe came into this period growing 2.5 percentage points, to turn that into a recessionary economy. There are, of course, a number of other policy changes, which I'm also showing our estimates for in this chart, some positive, some negative, near-term positive impulses from easier fiscal policy ex tariffs, near-term negative impulses from greater immigration restrictions, and also some of the spending cuts that we're seeing from fiscal legislation and DOGE, although those are very small, since DOGE obviously didn't have that much of an impact from a macro perspective. But the overall impact from the various policy changes, we think, is negative on near-term growth and peaking at about -1 percentage point. Now, what about the inflation effects from the increase in tariffs? There are two aspects to our forecast here, shown on the right-hand side. One, a meaningful pickup in core PCE inflation in the near term to about 3.5%, 3.4%, so about a percentage point higher from here. Number two, a subsequent return to about 2.5% by late 2026. So we've got two views here. One, significant increase in prices, but two, a price level effect rather than an ongoing boost to inflation with very large second round effects. What are the drivers of this? I think on the first, the main driver of our view that we'll see a significant price impact is really what we saw in past episodes, especially the 2018-2019 period, where you had very distinct and significant effects of tariffs on prices in the areas in which tariffs were actually applied. There weren't that many areas where they were applied, especially as far as final consumer goods are concerned. But if you separate out the PCE price index, or core goods PCE price index, into tariffed and non-tariffed areas, you see a very clear and distinct increase in the tariffed areas. Why do we think that it's going to be a price level effect as opposed to an ongoing inflation effect? I'd say one historical experience, when you look at, for example, European VAT hikes, of which there have been many, those boosted inflation for 12 months, and then inflation came back down to where it was previously, broadly speaking. And number two, we can monitor, of course, what's happening to inflation expectations. And there's clearly some evidence of increases in short-term inflation expectations. But as far as long-term inflation expectations are concerned, for the most part, the indicators that we have are showing, roughly stable long-term inflation expectations. That's certainly true for the market measures, break-evens, and inflation swaps. It's true for the New York Fed survey of 3-year and longer-term inflation expectations. It's not true for the University of Michigan, but I think the University of Michigan survey suffers from some significant shortcomings, in particular significant shifts in the partisan makeup of the sample, as well as a shift in methodology in 2024 from a telephone survey to an online design, which has put the UMich measures pretty far out of step with other measures of sentiment and confidence. I'd also note that there's still evidence of disinflation in other important indicators of inflation, in particular wages and rent measures. And left-hand side shows that wage growth is still trending down. The right-hand side shows that rent inflation is still very well behaved. I think that's also going to help in keeping this inflation increase more short-term. Now, what does it mean for the Fed? My answer to the question is one cut. We have one cut in 2025. We have two cuts in 2026. There's a very wide range of outcomes. I think the risks to that baseline view are tilted to the downside. If the Fed moves significantly away from that baseline path, in my view, it's much more likely to be large cuts. In a recessionary environment, we still have a 12-month recession probability of 30%. And if the economy goes into recession, if the unemployment rate really spikes, I think there's no doubt that they're going to cut by significant amounts, hundreds of basis points. And so I think current market pricing is, while below our baseline path, looks broadly appropriate in terms of our probability-weighted path for the funds rate. Just briefly on the fiscal situation, here's an estimate of the impact of the House reconciliation package on the budget deficit, and clearly we're getting a near-term expansionary effect, near-term tax cuts, and longer-term spending cuts. If you look, this is all relative to current policy. I generally look at things relative to current policy rather than relative to current law. Relative to current policy, it's sort of a mixed bag, and it's reasonably neutral if you look at the entire period of where fiscal policy is going. The other, I think, important point is that tariff revenue is not included in the scoring of these packages. If you do include tariff revenue, our estimate is actually that the deficit outlook is a little bit smaller. The projected deficit in our forecast is a little bit smaller now than it was in January. But overall, not really that much has changed. We're basically, we were saying that the federal deficit looks like it's going to be at about 6% of GDP. As far as the eye can see, we're still saying that the federal deficit looks likely to be about 6% of GDP as far as the eye can see. The fiscal bill ends up being more expansionary than anticipated, somewhat more expansionary, but there's also a significantly larger amount of tariff revenue. There's a growth hit from the increases in tariffs, so there's some offset there. But overall, not that much has changed in terms of the fiscal outlook, in our view. And the fiscal outlook is obviously very problematic, and you can see that on the right-hand side. The debt to GDP ratio in our forecast continues to rise in the next decade from a little under 100% right now to a little under 120% by the end of the 10-year projection period. Lastly, I just want to make one small comment on the dollar discussion. I agree that we are unlikely to see an end to the position of the US dollar as the world's dominant currency. With that said, I think the case for dollar depreciation in coming years is a strong one. And number one, this is based on the fact that the dollar is still quite strong relative to history in broad trade-weighted terms, adjusted for inflation. And number two, the fact that we need to attract net capital inflows of about 4% of GDP every year, I think points to dollar depreciation, assuming that the US no longer outperforms other economies by the same margin that we have gotten used to over the last 5 or 10 or 20 years. You don't need to assume a lot of deterioration in US economic performance to get to a conclusion that we're likely to have a somewhat harder time attracting these kinds of net capital inflows without dollar depreciation. And that's where we have oriented our forecasts. Let me pause there.
Jan, thanks. That was a great overview, highly detailed of the outlook. Well, first I want to ask you a follow-up question on inflation. So a lot of economists were surprised with the May CPI data of increases of only 0.1% in May, both for core and headline CPI. And, you know, it kind of like begs the question, when are these tariffs going to actually show up in the data? So, you know, what can you tell us about that?
Yeah, we were surprised. We were looking for 25 basis points on core CPI, and the surprise came in part in greater weakness in areas that are not exposed to tariffs. So the housing components were quite soft, for example. But we also saw less of a pass-through than we had built into our month-to-month forecasts in a number of areas. You did see some evidence of pass-through in home appliances, but other core goods did not show much pass-through. And it does raise the question whether, you know, maybe it's going to be a little bit smaller. And since we're always operating at the margins in our forecast, we do adjust our estimates even on the back of, you know, relatively small or very short-term surprises. We actually did shave the peak core PCE number in our forecast from 3.6% to 3.4%. We made a few other sort of small changes, but you know, from a broader perspective, I think it's very premature to believe that one round of monthly inflation numbers tells you that you were wrong to worry about a significant price increase on the back of these tariffs. One other small point I'd also make is that yesterday's import price number was interesting, not just in that it added a little bit to the PCE translation of CPI and PPI because of things like foreign travel, but also that it didn't really show evidence of foreign producers lowering their prices because you know, we actually had a higher than expected import price number. And if you want to make the case that that foreigners are going to absorb these tariffs, you'd have to see some big declines in import prices, and at least so far that has not happened.
All right, well, that actually anticipates half of my follow-up question, which was, might the weak CPI data reflect either price cuts on the part of foreign producers, and your answer is no, or reductions in profit margins on the part of domestic firms? Any view on that?
Yeah, I think it's got to be, well, so it could be either of those. We don't, you know, one import price number is also not conclusive. So we'll see what we learn about pricing of foreign producers. I would note that if you look at the Japanese corporate goods price data that came out a few days ago, there was a significant decline in export prices of Japanese producers of motor vehicles to the North American market. And that was one reason why I had sort of thought we might see more weakness in the US import price numbers, but so far this question is somewhat unresolved. I think absorption by US by US in US profit margins, I think, is another possibility. My favorite explanation for why we haven't really seen a significant price increase yet is the very substantial amount of inventory building at much lower prices. There was a lot of pre-buying of goods, and it looks to me that US retailers have decided to basically sell those goods still at the old prices and haven't passed through the higher replacement costs of imports into their prices. But I think at the moment we don't really know. These are all possibilities, and over the next 3 to 6 months, I think we'll get a lot more clarity.
All reasons why the Fed's going to wait and see. Let me ask you another question you won't have an answer for. Also on inflation. So you actually, it seems like you're making a slightly strong assumption that inflation expectations are well anchored, and that inflation is basically going to get a level effect. And I'm going to guess that the level effect ends up being about 2% on the level of prices, and then go away. And I'm wondering whether we seem to be in a more inflationary environment than we were back in 2019, and whether the fact that we had a big increase in inflation a couple of years ago might make both households and workers a little bit more sensitive to all that and lead to more second round effects.
Yeah, we're getting about 1.5, roughly 1.5 on the level, and that is spread out a little bit, so it ends up, and it comes against the baseline of probably still some disinflation in areas like wage sensitive parts of services, etc. But about 1.5. I'm open to the idea that there could be more second round effects than in past episodes, for example, of European VAT increases in the low inflation period of the last 30 years. I'm open to that possibility because, as you say, we did go through a much more inflationary period, and it's certainly reasonable to think that you could get a little bit more. I'd say so far, the evidence isn't supportive of that. And it's super early because we haven't really seen the price increases yet. But I am pretty struck by the fact that not only the market measures continue to show no problem from a long-term inflation expectations anchoring perspective, but that the New York Fed survey also is very, very similar to where it was a year ago. And so right now, I guess I'm with Chair Powell in treating the University of Michigan measure more as an odd one out, but very open to changing my view on that if the facts change.
As I assume the FOMC will be. Well, Desmond has been patiently waiting, listening to all this doom and gloom, and eager to correct the record on all that. And so let's hear what you have to say.
I'll just get up the PowerPoint that I've got.
Yes. Looks good to me.
Okay. Yeah, look, there's a lot of what's been said that I agree with, but in terms of doom and gloom, I think that this panel so far has been far too sanguine. That everything to me points in the direction that we are going to have real trouble, and the real trouble we're going to have is not going to be in the never never land, never never time. It's going to be relatively soon. I'd say that you've most got 12 to 18 months. And let me go through the reasons why I think that this is the case. So there are really 4 points that I'm going to make. The first is we've got a major twin deficit problem that's going to get worse. The second is that this administration seems to be going out of its way to undermine confidence in United States assets, which isn't a good idea for a country that is highly indebted and dependent on the kindness of strangers. The third point I'm going to make is that there are plenty of signals that a nasty process is already underway, both in the bond market and in the dollar market. So you've already got the process starting. You can't afford to make mistakes. And the last point I'm going to make is that sinking foreign economies isn't in the United States' interest, that it comes back to bite us. I should just mention that I'm not going to say anything about the potential for a major oil price shock or geopolitical event. Those are other things that just would make the situation far too gloomy. So let me just start with the twin deficit problem. We've already discussed it, but I think that it's worth just taking a look at the numbers. The numbers are really scary. The United States is running a budget deficit, not going to get better. This big, beautiful bill is going to make it worse. It's what's been said before. We're running deficits at 6% of GDP plus for as far as the eye can see. That leads to a debt situation that is really just mind-boggling, that your debt is higher than it was at the Second World War. There's no way you're going to grow your way out of that, demographics and all the rest. This is a really serious debt problem. This reminds me very much, I wrote a piece for Project Syndicate saying that this looks very much like an emerging market economy to me. Now the trade deficit, I just thought this chart is interesting, just shows the trade deficit increasing. The pink line, the line that is lighter, shows what happened during the previous Trump administration. So it really is Mark's point that if you can put on the tariffs whatever you like, but if your saving investment imbalance isn't too good, you're in trouble. So the tax cut there, what it did was it reduced government saving, it incentivized investment. And we're very surprised that the deficit widened. Why it's not going to happen this time around beats me. You've got exactly the same mix of policies. A big, beautiful bill is going to be incentivizing investment, reducing saving. I don't see how you don't get the deficit widening. So that's so much for the deficit. This chart just, it perhaps just redundant, and basically just saying that savings has collapsed in the United States. So let me just move on to the point, why I think, what Jason called the non-linearities kick in is because you've got an administration that is doing everything that can undermine confidence. They're running a big, beautiful bill that is putting the finances on a even more unsustainable path than they were before. They beat up on the Federal Reserve. They're telling you that they're going to put in new people or that the Fed needs to reduce interest rates by 100 basis points. That just smells of inflation to any holder of foreign bonds. Why are they going to hold these bonds if you're going to inflate them away? You've weaponized economic policies, with sanctions on countries like Russia. So, why do you want to hold dollars if, that these can be easily weaponized? And then just to add to things, you've got Section 899 in the big, beautiful bill, that Mark referred to. You're telling foreign investors that you can possibly put a 20% tax on them. Who in their right mind is going to hold bonds, if they think that there's going to be a 20% tax? And then you've got some clown talking about forcing conversion of bonds into a 100-year zero coupon bond. So you have to be an idiot to be holding these bonds. So those are really the reasons why I think that you've got a very bad deficit situation, and then you've got a huge amount of financing needs, and here you're going and telling people that you're going to be confiscating their wealth. This, of course, is not a good idea to beat up when you're so dependent on foreigners. This chart basically just shows that the amount of treasuries, you've got a treasury market that's roughly 29 billion, and something like 8.5 billion is owed by foreigners. And you've got you're the largest debtor nation in the world, so I don't think it's a good idea to mess around, tell foreigners that, you might not be honoring your commitments one way or the other, whether you're inflating it or whether you're taxing it. It's not a very good idea. So let me move to the third point, which is that I think the markets are already flashing warning signs that something is going on. So warning sign number one is long-term interest rates. Normally when the Fed cuts the interest rates, you'd expect the long-term rates to fall. That hasn't happened. If you just look from September, Fed's cut interest rates by 100 basis points, and the treasuries have risen by something like 70, 80 basis points. That's not very good. You also got the dollar is just tanking when there are plenty of reasons why you think the dollar would increase. That if you put 10% tariff on, you'd expect the dollar to appreciate, the other currencies to depreciate. Didn't happen. The Federal Reserve holds interest rates steady. The European Central Bank cuts the interest rates, dollar falls. So there's obviously something going on. If that's not enough reason to think there's something going on, just take a look what's happening to gold. Gold now has surpassed this might reveal my South African bias. Gold has now 2,000 years of investing history, can't be wrong. Gold has surpassed the euro in terms of international reserve holdings. Apparently it's now something like 20% of international reserve holding versus something like 16% for the euro. So it looks like people are already moving into gold out of dollars. So I'm saying that all of these signals from the interest rates on the long term, from the dollar depreciation and gold, are telling you that something is going on in the markets. You don't have room to mess up. If Trump messes up some more, which we can count on him doing, if you just judge by what's occurred for 6 months, this is going to cause movements. And I think that once these movements start, they tend to feed on themselves. So, for those reasons, I think that all of this is not good. And of course, if bonds go up, you get stresses in the financial system. This is showing you the mark-to-market losses of the banks. They're holding huge losses already. You can't afford the long-term interest rate to go up. Long-term interest rates going up messes up the rest of the economy, etc. So I don't think this is a very good picture, to say the least. The last point I'd make is, if you're putting tariffs on countries like China, you've got 55% tariff on China. If that causes China to slow down, if you cause the other countries to slow down, that comes back to hit the United States in a variety of ways. Our export markets get shrunk. It's not good for the banks who loaned, but it's also not good for the stock market, where, this chart is just showing you that the S&P 500, the revenues, 30 to 40% of their revenues come from abroad. So, if you're getting a slowing abroad, and I guess the last chart I'll put up is just showing you that equity valuations are awfully high, that the equity markets generally aren't very good at foreseeing real danger ahead. But this suggests to me that there's huge potential for a lot of downside move on the market. So I'm wanting to take Jason on the bet that something occurs within 12 to 18 months, that is not going to be in a few years' time. You're going to get some big accident that's not going to be pretty. I'll just conclude by saying that if I'm wrong, what I'll do is I'll resort to my Bertrand Russell defense. When he was asked, he was an atheist, and when he was asked what he would say when he was confronted with his maker, he would say, "Sir, I was wrong, but all the clues were pointing in the opposite direction." So I'll leave it at that.
Thank you, Desmond. That was very illuminating, if not particularly optimistic. Um, so all three of our other participants, I think, have been calling for one Fed rate cut this year, which suggests that while they're alert to the possibility of recession, that's not their base case. Uh, what do you think the Fed should do, and what do you think the Fed will do in this situation?
Uh, I would say that, certainly if you give me 12 to 18 months, I'd say that what you're going to get is you're going to get many, many interest rate cuts. And not only are you going to get many, many interest rate cuts, but you're going to get the Fed beginning asset purchases in a massive way again. That if there's no bid for US Treasuries, who's going to be buying? This country can't tolerate a treasury rate of 5-6% at the long end. That would totally sink the economy. It would cause huge problems in the banking system. The Fed is going to have to step up there and buy all of the stuff. But the Fed is not going to do anything until you really get into a crisis mode. But once you get into crisis mode, the Fed will go full guns like it did in 2008, like it did during the pandemic. So I'm in the camp that the Fed's going to be cutting many more than 2 times the next 12 months.
All right. So one last follow-up. So you point to all these market indicators suggesting people are losing faith in the U.S. economy and government. But the stock market doesn't seem to be one of them. Are there just different groups of investors, or are people conflicted, or what?
I don't know whether Jan has the same experience, but when I worked on Wall Street, I was told that the smart money is in the bond market, the dumb money is in the stock market.
Jan, does that still hold?
I think that view is certainly widespread in terms of the ability of markets to predict what's ultimately going to happen. I think all of them have a checkered record. So I wouldn't necessarily say that stocks are always to be ignored and bonds are always to be taken as an accurate signal.
Yeah, but the stock market.
I mean, there is the wisdom. You're aggregating more information in the stock market than in the bond market because you have a lot of investors looking at individual companies, and however smart or not smart they are looking at real information, and that knowledge gets aggregated in the stock market. And that's one aspect. Obviously, that doesn't mean everything's efficient. I'm not saying that, but there is a certain amount of value in the information that comes out of the stock market. And right now, it's saying that the world's not falling apart, and it's early. So, I would put at least some weight on it, and I wouldn't dismiss it as readily.
Yeah, the Middle East looks like it's about blowing up, and the stock market thinks that this is a picnic.
Maybe they're wrong. I think I'm totally open to the idea that they're wrong, but you've got to look at the valuation. This is also not. I mean, on that, I don't think that the stock market is going to provide a lot of information, because that's about a guess of what's going to happen and geopolitical judgment and so forth, which I'm certainly not an expert in. What I'm talking about is the evaluation of earnings trends and outlooks for individual companies. And that is one aspect of what drives equity market moves. And I'm just saying that the message from that is not that negative at the moment.
Yeah, I assume there's also.
I mean, you can't be right that ultimately things tank, in a much more dramatic way, because this is more nowcasting than forecasting. But I do think you should put some weight on it.
If I could just make one point, is that basically the stock market is got valuations now that are very reminiscent of just before the dot-com bubble burst. So you're at incredibly high historical valuations, which seems to me that it's pricing in perfection. And what you've got is you've got a geopolitical situation that is extremely problematic. You've got two land wars going on a big scale, but forget about those. You've got economic policies by the Trump administration that are insane. And the market is kind of like thinking that this is all going to work out just hunky-dory. There's no way that those valuations can be maintained if policy continues on this path. That's the only point I'm making.
Let me
I mean,
cut
there's
in here and let me just say that. Yeah, go ahead, Jason.
Oh, I say, first of all, there's a long history of you could make fun of the market for not seeing what's around the corner. There's also a very, very long history of people warning, given this uncertainty, that problem, et cetera, the market's about to go down, and being wrong 9 out of 10 of those times. Part of what's going on here with the market, and I think it's also relevant for thinking at the economy a little bit past the horizon that most of this discussion has been about, is AI. And the market obviously is very concentrated in certain stocks. It's very concentrated in the United States as opposed to the world as a whole. And, are there 20% chances that, there's just enormous, enormous financial value creation in AI? How much is that affecting, is that affecting the pricing? That also is something that I wouldn't really update my macro growth forecast for the next 2 years. But if you're doing a 10 or 20-year time horizon, certainly there's just a lot more upside risk because of that at the very minimum, compared to what there used to be. So your distribution of growth has to be a lot more skewed, even if you keep your mode, not particularly changed.
Do you think it makes sense that that foreign investors, who I assume have been, certainly part of the equity price rebound of the last couple of months, would, if the administration's current not so great policies continue, start to shift their share of equity investments into Europe and Asia? And there is a certain amount of buzz about maybe the European economy doing well going forward. Any views on that? Anyone?
I mean, this is the thing people say that it takes, decades to grow a forest or build a cathedral and only a few hours to burn it down. And I think we're seeing that that's actually basically wrong. That the United States just is so enormously credible, so liquid, has so many strengths in terms of its financial markets that you can do quite a lot to it, and people remain interested in keeping their money here. And of course, there's the comparison to what your other choices are around the world. So again, I mean, I sort of agree with every single thing Desmond said. I think every aspect of economic policy we're seeing is risky and unnecessary and wrong and will be punished, whether it's punished in basis points or percentage points, and whether it's punished, 1 week from now or, 1 decade from now. In some sense, in all of those cases, it's a mistake to be doing it. But, that being said, I would personally bet on a greater degree of robustness. But still wouldn't, it's not what I'd make my policy based on.
Right.
In terms of foreign investors, I mean, I do think there's a bit of a lack of alternatives to holding a lot of U.S. assets. So I'm not getting the sense that there is wholesale shifting away from U.S. assets. One area where I do think there are some changes is in hedging currency exposure. There are a lot of large pools of global money that have basically, been very lackadaisical about hedging dollar exposure, in part because it was working. The dollar was appreciating, and if you did a little bit less, that worked in your favor. And I think there is clearly a shift, and I base this on, a variety of, in some cases, anecdotal data points. There's clearly a shift towards more hedging of dollar exposure, and I think that can still go quite a bit further. And I think that is one reason for why I would expect the dollar to depreciate.
I'm
Um,
with Jan on this issue, and just to repeat that the portfolio managers tend to re-benchmark portfolios gradually over time.
and so the implication is what?
The implication is that I do see some erosion where foreigners are less likely to put their money here and to seek out equity alternatives if there are good ones elsewhere.
Okay. Um, So I think it seems like there's a lot of consensus on kind of like the causal mechanisms and just kind of like different weights on the baseline versus downside risks. We've gotten a couple of questions from the audience that are kind of like less focused on that and more focused on the trade deficit. And questions about, is the trade deficit an economic problem? And does it threaten national security? And so, with some deference toward satisfying our audience, does anybody would like to opine on those questions?
I would like to say that trade deficits are not a national security problem, but what's relevant is what drives the trade deficits, and bad policy that shoots Americans in the feet is perhaps a national security issue. So tanking U.S. credibility, harming our relations with our allies, that does raise big time issues. Is the trade deficit an economic problem? Again, we've talked about savings and investment imbalances and how our excessive wrong-headed fiscal policy may be a factor involved in our trade deficits. But the trade deficit is a product of that. And as you and I have discussed, trade is good for the U.S. It gives us access to lots of products we wouldn't otherwise have. It keeps a lid on inflation, and autarky is hardly an answer.
Yep. Steve,
Go ahead.
I guess a point that's worth making about the trade deficit is that basically what a trade deficit does is it allows you to live beyond your means. So if you're going to get rid of the trade deficit, you're really going to have to engage in belt tightening. Otherwise, you're going to have inflationary pressure. So this notion that the administration is spinning that all these countries are ripping us off, that they're getting wealthier at our expense, that they're building up wealth. Basically, what they've been doing is they've been allowing us to live beyond our means. And the administration's policies are totally inconsistent. If you want to get rid of the trade deficit, you can't at the same time be expanding your budget deficit. You basically got to be reducing the deficit to make this thing hold together. Otherwise the policies are just so inconsistent that, as I said, it reminds me of what I used to see in the emerging market economies.
Let me just say, I mean, the current account deficit in the United States, if we were at about 3% of GDP or below, I wouldn't be worried at all. That is, given the higher rate of return that we get on our overseas investment than they get here, that the income flows associated with that are roughly neutral, and that's something we could sustain indefinitely. We're probably a touch higher than I'd like to be in terms of our trade or current account deficit right now, but only a touch. That is also caused by our domestic policies. It's only really solvable with our domestic policies. And finally, I would say there are a set of national security issues, but they're not related to whether you have a trade deficit or not. Even if we had a trade surplus, if we were completely dependent on China for rare earths or for drones, then we would be very vulnerable to China. And that doesn't change whether you have a trade deficit or trade surplus. So there's important trade issues within certain sectors and products and with certain countries, but they're much more about resilience and reliance than they are on, keeping score by adding up, who imports and exports, what quantity.
Well, sounds like we are as one on this issue. Why don't we,
Well, I was trying to be once again more sanguine than Desmond.
well,
But
not,
you mentioned China, and as soon as you mention China, you've got to think about Taiwan. As soon as you think about Taiwan, you've got to think about semiconductors. So, there's another risk, that there just risks all over the place, and the stock market at least is pricing in as if there are no risks.
all right, no more risks. All right, we're coming up on our time, not the noon aforementioned time on our website, but the newly consecrated 11:30 deadline. So I'd like to maybe all our participants could leave our listeners, with some choice words of wisdom. Going in reverse order, maybe starting with Desmond. What succinct message would you like to leave our listeners with?
I guess, basically in a word, sell, and in 2 words, buy gold.
Okay, that was especially pithy. Jan, what would you like to say?
The tariff escalation is likely to hit growth significantly and lower GDP over the longer period, the level. But given what we now expect, it's not enough to cause a recession.
All right. Well, I hope that remains true. Mark?
Um, I would say that the United States, we can be our own worst enemy or our best friend, and we shouldn't focus on blaming foreigners all the time. We should focus on keeping our house in order and improving policy and doing far more sensible things. And everything will be much better then.
Well, you're not my favorite co-author for nothing. Jason, how would you like to leave us?
Yeah, there's just an extraordinary amount of uncertainty in terms of what's coming down the pike. But there's certain things we're nearly certain of. And one of those is that the debt is unsustainable. You can debate the magnitude, you can debate the timing, but keeping our eye on fiscal policy, which will be more of a driver of monetary policy, for better or for worse. The for worse would be in a fiscal dominance type of way, is going to be more of a driver of monetary policy for some time to come.
All right. Well, I'd like to again thank all our participants, our panelists, for contributing such interesting insights and for their discussion with each other, and for answering the audience's questions. So it's been great, very informative for me. And I hope you have a good day, a good summer, and I'm sure we'll all be listening to hear what my ex-boss, Jay Powell, will be saying uh, in basically looks like 3 hours. So until then, enjoy your lunch, and I look forward to seeing our audience at some other point.